Good evening, everyone. I am CA Pooja Kathuria, the moderator of this webinar. We are delighted to welcome you all to this insightful webinar organized by the Committee on Financial Markets and Investors Protection. It is my distinct pleasure to serve as the moderator for today's session on pros and cons of a reverse merger with listed company, rule-based systematic investing, a topic of paramount strategy that allows small private companies to grow and go public, meticulously curated by the Committee on Financial Markets and Investors Protection. In a short while, we will commence this webinar. And before we delve into the presentations and discussions, I would like to provide a brief overview of the topic pros and cons of a reverse merger with listed company. Through this session, we aim to explore the reverse merger, also known as reverse initial public offering, that is, one way that a small private company can become public by purchasing control over a large public company. Now, I would like to welcome Chairman of the committee, CA Charanjot Singh Nanda sir, and would request him to give a keynote address. CA Charanjot Singh Nanda sir is a member of Central Council of ICI. He presently holds chairmanship of three councils of ICI. Over to you, sir.
Thanks a lot, Pooja ji. My salutations to CA Vivek Subramaniam, who hails from Hyderabad. And today's exciting topic, the topic today is pros and cons of reverse merger with a listed company, taken by Mr. Vivek Subramaniam. And the second one is rule-based systematic investment, which is taken by Mr. Rakesh Pujara. Ladies and gentlemen, I am excited to welcome to you to yet another session, a very happening session on stock markets. Yesterday, the markets ended at the top level, all time high. And I want to tell you, people want to invest in the market and make money. But when you invest in the market, you need to understand risk is paramount. You have to understand that risk is something that will put you out of gear. And to be involved in the game to make money consistently, you need to understand how to put stop losses, how to create targets, and more importantly, how to go ahead and make value by investments. If market was a person, say people feel after trading of 1 or 2 days that they understand the markets because market has either to go up or go down. So they feel it is very simple to invest in the market. It is not so. If market was a person, it would have said, क्या यूं ही मुझे चंद लम्हों में पढ़ लोगे तुम? क्या यूं ही मुझे चंद लम्हों में पढ़ लोगे तुम? मैंने खुद को लिखने में बरसों लगाए. Markets need lot of indulgence, lot of involvement, and more importantly, they need lot of research, and research has to be around. Mr. Venkat Subramaniam is a seasoned chartered accountant, and he will take you through the reverse mergers with listed companies. He has been a pointer into it. And second, the rule of systematic investment again would tell you the areas which ultimately turn to be pain points and areas where you could heap a lot of money, create value and worth by investment. Ladies and gentlemen, I will not stand between you and the worthy speaker, Mr. Venkat, who is on the dais. So I give back the dais to Madam Pooja Kathuria. I'm thankful to her that she also very kindly consented to moderate the session. Pooja ji, the dais is all yours now. Thank you.
Thank you so much, sir. Now,
Thank you.
I would like to introduce our eminent speaker, CA Venkata Subramaniam V. Sir. He qualified CA in 1987. He has handled 149 IPOs as a share registrar, conceptualized reverse merger in 2000 in organized way. He is actively involved in software and animation businesses during 2000 to 2005. He advises corporates in strategies and IPOs. Presently, he is reestablishing share registry activity. Over to you, sir.
Thank you very much. Thank you, Nandaji. Thank you, Poojaji, for your words. And I'd like to share my screen first. Pujaji, you are able to see the screen?
Yes, sir.
Thank you. Okay, so today's topic is reverse merger with a listed company and how we are going to do the reverse merger, and why, and how it is different from going for a public issue on its own. What are the advantages and the disadvantages, and what is the shell company, and how shell companies form, and what is the strategy you as a chartered accountant and a consultant to the company should advise your client if somebody approaches you for a reverse merger, and how we can oversee the due diligence. Friends, always remember that when we buy a company, we buy asset. We should not buy a liability. So especially, it's very tough, to go through this process of buying a shell company, because there are a lot of complications involved. Okay. So here the components are, one is a shell company, another a private company with business, and which results in a listed company with operations and EPS. The first scenario is shell company buys the business of a private company. So there will not be any further increase in the capital, which we are going to discuss, in our coming slides. And if both the companies are in business, a listed company and a private company, both are in business, generally they go to NCLT for a merger, which results in increase of capital in the listed company. Okay, that is one approach. And the third approach is, one of the companies might be going through insolvency process in NCLT. So then both the companies get merged, and that integration is mentioned in the resolution plan. In our the next 1 hour, we are going to discuss about the shell company, bought by the private companies. Okay. What is shell company actually? Shell company we can compare with a patient who is in coma, because generally there is no business, there are no operations in the company other than listing. If you see, if we give oxygen to the person in coma, he gets up, he becomes active, and he can run. That's exactly what happens with a shell company when it is injected with a business from a private company. Next question is, actually, we need to deliberate. Why going for a public? What is the purpose of going for a public? And why? We will see this. The advantage is, one, access to the capital. It is very easy for a public company to raise money than it is for a private limited company, because every publicly traded company makes its financials public. The investors, because of transparency, the investors feel comfortable. That's one. Point number two, liquidity. Exit route is available to the investors. So people, then they feel comfortable in investing in a listed company than in a private limited company, because you don't know when you can exit from the investments. Third one is valuation. It's very difficult to value a private limited company. There are a lot of complications are involved. Whereas a public limited company, the stock price is the valuation of the company, and earning per share from the financial statements, whatever they submit to the stock exchange, from that one we can derive what is the earning per share, and multiplied by PE multiples can determine the stock market price. So for an investor, it becomes very easy to get in and get out of any listed company. And the other advantage is the stock options. To retain the talent, we always prefer to, it is always better to give some shares to the employees. And the public limited company gives that option. Through this option, we can attract talent into the company. Option holders are highly motivated to perform, you see, towards the success of the company, so that the stock price goes up. When your employees are able to perform better, so naturally the performance is reflected in the profits of the company. Automatically, earning per share will go up, and it results in stock price goes up. So it will be win-win situation for everybody. So that is the one advantage of being a listed company. Then listed company can grow faster through acquisitions. What happens once you are a listed company, you become your shares become currency. Then promoters can pledge their shares and raise money, and that money can be used for acquisition of other companies, or they can go through a rights issue, or they can go for preferential allotment. So attracting investors becomes very, very easy. The other option is transparency. Every listed company is expected to, is supposed to submit quarterly, half-yearly, and yearly reports, and the shareholding pattern, corporate governance, secretarial audit reports, which generally makes investors comfortable and confident. And again, there are strict insider trading norms are there, insider rules and regulations. So that can help the companies to raise further money from the market. Okay, these are the advantages. Let us see disadvantages also. So if you see, one is every company lives from quarter to quarter. Every quarter, you are supposed to submit your results. If there are any problems or if there is any downfall in the sales and others, automatically it will reflect in the stock market price. And two, there are a lot of public disclosures, statutory obligations are there as per SEBI. And every public limited company is supposed to maintain that. And two, this maintenance is very, very expensive because they need to have a separate compliance department. So these are the disadvantages of being a public company. Then we see, we are trying to understand, about the IPO process, then we'll come for this reverse mergers. So if I go for a traditional IPO process, what happens? We need to go for appointment of merchant bankers, investment bankers, registrars, underwriters, brokers, and market makers, and bankers to the issue. And once we decide to go for public, then we need to appoint a merchant banker, and merchant banker prepares a prospectus, red herring prospectus, and they file with SEBI. SEBI goes through that prospectus, and most of the time they ask a lot of questions, and merchant bankers have to respond to that. And once they clear the prospectus, merchant bankers have to come for a public issue in 3 to 6 months' time. Then they appoint advertisers and market making. Then we have to open and close the issue. So this is the critical. By the time we decide to go for a public issue, and by the time we open the issue, markets may change, market conditions may change, and sometimes issues, beautiful issues also might get into problems because of this timing issue. So this is the risk factor for going for a public issue directly. And once issue is closed, subscription comes and issue is closed, 90% of subscription should come. Then only they can close that issue, or else they have to return the money as per the rules. So then they have to file with the stock exchange. Initially, they get an in-principle sanction, and after that, they have to file for the listing permission and the trading permission. Once the trading permission is given, then they can go for the trading of the script in the stock market. So this process generally takes minimum 3 to 6 months' time. So I have seen a lot of companies, the moment the day they plan and by the time they come for an issue, so sometimes it goes beyond 1 year and 2 years also, some cases. So most of the times the requirements of companies, funding requirements, others are not met. That is the issue with this traditional public issues. So now let us try to understand what is reverse merger. So reverse merger is a transaction in which a privately held company merges with a publicly held company which has no business, no asset, and no existing business operations. So such company is called, public company is called shell company. So once that merger takes place, privately held company instantly become public company. Okay. So you may get, I mean, how come these shell companies come in existence? Shell companies are companies which go for public issue, which has gone for public issue, but because of failure of their business model and termination of operations for various reasons, so they continue their listing, but there are no operations in the business. There are such companies existing on BSE and NSE even today also. So what are the advantages of reverse merger? Lower cost. If you see, I have seen a lot of companies going for reverse merger, and the cost of the total cost may not cross more than 5 crores. And in case of a company going for IPO, the cost involved would be anything between 10% to 20%. Okay, and two, the costs are predetermined. We know what are the costs. If you appoint a merchant banker, we know how much it is going to cost. We know about the registrar, and once the due diligence of the reverse merger is targeted company is over, then generally promoters and acquirer negotiate and they come with the pricing part. So the costs are predetermined. We know how much we are going to incur the cost. And as I mentioned, this the whole process is very, very fast. The whole process, I mean, one can complete it in a span of, I mean, maximum 90 days, 60 days to 90 days, you can close that completion. And here, if you opt for reverse merger, so you're not, I mean, market sentiments don't play any role here. You're not, you need not worry about whether the issue gets subscribed or not, things like that. So simply, you can finish your work of acquiring the company. And as I mentioned, it's not time consuming. I mean, we are very clear what we are going to do it. And in this span of 60 to 90 days, we can close it. And one more advantage is that the acquirer can have shares to the extent of maximum 75% of the listed company. Most of the times, I've seen a lot of companies get listed, not for raising money, but to get their shares listed. So in such cases, promoters prefer to, I mean, the new promoters prefer to take 75% of the listed company. Okay. So, and the other thing, what we say is there are no underwriters and brokers. Okay. So how you go for a reverse merger? So you need to identify a shell company first. So we discussed how a shell company is created. Yeah. I mean, these are the questions we need to ask before going for before taking over a company. So you need to find out you means I mean, as a consultant to that acquirer, how it was created. Was it created because of bad business, or promoters have siphoned off the money by taking money from the public and later they made this company sick? I mean, those are the things you need to see. And two, do they have any assets? Any assets are there, liabilities are there? Because why I'm saying about liabilities, though we are talking as a shell company, whether they have given any corporate guarantee to anybody, because tomorrow that will not come onto you. Okay. And two, whether they have pledged their shares with any bank, with any bankers or third party also, one has to go through that. And another important thing is it trading or there is no trading at all? It is listed, but it is not actively traded. So, because one has to see, our trading is suspended. If it is trading is suspended, they need to follow up a separate methodology to get it activated first, then only they can go for reverse merger. Without suspension of, without revocation of suspension of trading, if they take over the company, the stock exchange may not recognize and they may not revoke suspension in trading. So this is one aspect what one need to see. Recently, in one case from Chennai, one person had taken over a suspended company, and the suspension was not revoked. We lost all that money, what have we invested. So one has to be very, very careful. And another aspect we need to see is the shareholding pattern. What are the reported shares held by the promoters? And whether promoters are holding some shares in the name of friends and rentals. Because what I am saying, is it are they holding 50%, 60%, 75%, or more than 75%? So that report one has to take it from the existing promoters. Another important aspect is that is it a clean company or unclean company? What I mean is if promoters have indulged in some unethical practices and made the company sick, and then it is an unclean company. And I suggest that you stay away from such companies because some baggage would come to you in future. And now we are talking about this. What is the process of reverse merger? One is identification of the company, what we discussed. Then the promoter and promoters of the listed company and the acquirers, they have to sit in the negotiations and preliminary due diligence. Once they agree in principle, then they have to enter into some sort of understanding that is called negotiations. As a chartered accountant, you can represent the acquirers and then interact with the promoters and come to an understanding about the pricing part. So then the important thing is the due diligence, which we'll elaborate in the next slides. So that is very, very important thing. The due diligence, the day they come to an understanding in principle that yes, we should look at this option of taking over the listed company by the acquirers, you should set up a data room. In the data room, you should have one is a financial due diligence. In that one, you should keep audited financial statements, unaudited financial information, if there is anything. Financial statements submitted to the stock exchange, and all the tax returns, cash flow statements of this listed company. So that is one financial side. Legal due diligence, which is including the secretarial due diligence, memorandum and articles of the company, documents filed with the ROC, prospectus filed earlier with the SEBI and stock exchanges. And importantly, you should see whether there are any pending litigations. Okay. Apart from that, you should get this market reports, website, directors and promoters information also. You should prepare a statements and submit to this acquirers. Another important thing is once you decide to take over that listed company, I suggest it's a practical experience. One or two of your acquirer nominees should get into the board so that they can start actively involved in the management of the company. Once you announce that a takeover, then the board, constitution of the board cannot be changed till the takeover process is over. So I suggest that one or two nominees of your acquirers, it is better to get into the board of directors. Okay, and the two, then acquire majority of the promoter shares through share purchase agreement and take control of the management of the company. Okay. Then immediately you need to appoint a merchant banker and announce a takeover code. Because here this is an important aspect of takeover reverse merger. Once you take any listed company, more than 25%, takeover code kicks in. Immediately, you are expected to make a public announcement, offer 25% of the public holding that you would be taking over. That is the guidelines. SEBI is very strict about it. So the moment you make announcement that you are taking over this company or your intention to take this listed company, then immediately within 24 hours you have to make a public announcement. Okay. So one needs to understand the intricacies involved in taking a listed company, and as a consultant, you should advise the acquirers that they should identify a merchant banker, interact with a merchant banker, and make them ready, because the time frame is very, very less. Within 24 hours, you have to do it. And process to take control of the company is 15 days, but the process to complete the takeover is 3 months. Here, there are 2 points. When you take the company, SEBI is not saying that they're not coming in the way when you want to, when you're acquiring the shares of the promoter, they don't have any, they will not say that you should not take over this company or anything. What they are saying is you should take 25% of the public holding from the public. That means if the public holding is 50%, the promoters is 50%. You are taking 50% of promoters. Out of 50% of the public, you should take 25%. For all the 50% people submit their shares to you, then proportionately you can take 25%, or you can go for 50% also. That's a different issue. Okay. So this takeover is very, very important. I suggest don't go for it out of the way and take only 25% of the company, less than 25%, and balance shares, keep it in the friends and other known people. That will create problem for all of you. So this takeover is not a very costly affair. You can control that expenditure also. The expenditure may not be more than 40-50 lakhs. Go through this takeover so that that cleaning process happens. Next, about this shareholders agreement, share purchase agreement. The share purchase agreement, we specifically mention about the indemnity and warranties. Suppose if there are any unknown liabilities are there which are not reflecting in the balance sheet, you have to make it very clear that the acquirers are not responsible and the previous promoters are responsible for such liabilities. Okay, so ensure that when your share purchase agreement is drafted by a good lawyer, advocate who knows about this drafting part, and because if there are any issues of whatsoever that may come up in future, you can always escape from that liability. So, we are talking about takeover. So takeover code, the rule is 25%. 25% of any listed company you are acquiring by any individual or a group of individuals in a consortium, that such group or individuals should make an offer to the public that you would be acquiring 25% of their shares. Okay. So once this takeover process is over, then completely there can be change in the management and complete takeover process, you can complete it. There is one interesting aspect. Suppose if any of this company, one of the companies, listed companies in NCLT, they are going through this NCLT. So, resolution professional submits, the bids and everything. And if the resolution plan is reduction of capital or increase in the capital, then this takeover code is not applicable. So IBC overrides all the provisions of LODR. Earlier I mentioned that one, it is very, very cost effective, the reverse merger. Whereas expenditure for the IPO is almost 10 to 20% of the issue size. I've seen in some cases, the smaller the issue, the bigger the percentage. I've seen some cases, it is going beyond 30-40% of the issue size also. So in case of reverse merger, the major expenditure is only for buying the shares from the promoters. The other expenditure is only from the merchant bankers and advertisement. It's not a major one. So this we have already discussed. Access to the capital. And we discussed about this SEBI takeover code. And generally, once the takeover is completed and we submit to the stock exchange, I mean, new promoters and existing promoters step out, and the new acquirers become promoter of the company. So those information we need to submit to the stock exchange, and most of the time they lock the shares for 3 to 6 months time. So during this time, the new promoter shares cannot be traded in the stock market. This is the calendar, what I'm saying, this takeover process. So if you see, suppose today we are starting this process, signing the agreement, and we have to make announcement to the stock exchange, and within 60 days, by 11/3/2024, we can close this issue. I mean, complete that issue. Okay, this is the calendar, and if any one of you want this calendar, just send me mail, I can send it to you. Okay, this also I mentioned about. Coming back to market perception of reverse mergers. People say that when it's a backdoor entry and why we are getting into it, why the companies cannot come for a public issue on their own. But a lot of reverse mergers have taken place and the companies are doing pretty good. There are some companies where promoters have taken advantage of investors, but some of the companies I have seen, they are doing pretty good in the stock market. Ultimately, it is the business and business operations and net profit which take the companies to the next levels in the stock market. So initially, there is a market perception is not good, and even regulatory point of view also, they have their own apprehensions about the reverse mergers. But I see this as a good strategy to get listed. Okay, so when this takeover is happening, or when the company is being taken, any non-disclosures might disrupt the process. So the promoters are, as a consultant, we should be very, very careful that whatever disclosures they are giving, they are transparent and they're clear. And you cannot take more than 75% of the equity from the acquisitions, but if it is resulting by virtue of your acquiring public shares more than 75%, then you have to give a declaration to the stock exchange that you would be offloading shares in the market in future. Okay. So the other issue is when two different cultures are, corporates are getting merged or integrated, we have that cultural difference, we have difference of opinion of the promoters, things like that. So as a consultant, you have to ensure that there will not be any hiccups in future, and the whole process goes through, smoothly. So you have to ensure that. So post-reverse merger, what we should do is that I suggest change the name because one, the present operations and the new business and the new company. So this should reflect that activity, and whatever the baggage the old people and old promoters have will not get carried. And secondly, we need to revamp the board of directors. The old promoters, they retire. You need to revamp the board of directors. I suggest get 2 or 3 good independent directors who are well known in the business circles. So that will give a good vibe to the company. And then focus on showing the good results in the next, upcoming 2 or 3 quarters. That will take the company, that will create a lot of visibility among the analysts and the investors, including brokers. And then set up a team for investor relations. There are IR agencies are there, good agencies in Mumbai, in Hyderabad. And you can contact one of them and try to create a good image about the company, rebuilding the company's image. Then start talking to some analysts after 1 or 2 quarters, not immediately. Then once you start showing the results, then they will come to you. And, then the momentum, the price can happen. One more thing, already that listed company must be doing all these activities earlier, but once you take over a listed company, then you should have your own chartered accountant and a company secretary. Company secretary should be a qualified company secretary, whereas the CFO, I'm surprised that they have not said it's a chartered accountant should be there. I request Nandaji and our institute to look into this aspect. Money is also important for a listed company, not only corporate governance. So the CFO should be a chartered accountant. Of course, most of the big listed companies, they have not many chartered accountants, but I'm surprised why it is not made compulsory. So our institute has to look into this aspect. Okay. And 2, you have to advise your client that they need to adhere to this quarterly financial, the secretary reports to the stock exchange, and review the existing share transfer agent. You have to interact with them and see they satisfy they're continuing their registration with the SEBI. Either you can continue them or appoint a new share transfer agent. And then similarly, you have to review these agreements with the CDSL and NSDL, and with the BSE and NSE also, because they take this annual listing fees to ensure that they're up to date, so that company will not get into any issues. One more aspect is we need to see is stock exchanges. SEBI has implemented GSM and ASM, graded surveillance mechanism. Once your share price is going up, moving, then you will be coming under this surveillances. You have to be very, very careful, and sometimes you may not be having any control over it. So how to come out of this GSM? That is a separate topic. We have to see. We need to discuss separately about that. Then, if your company, has a turnover, market capitalization more than 100 crores, things like that. So GSM, you don't come under this surveillance mechanism. So how to get into that mode? How to insulate yourself from GSM and ASM? That is one aspect every listed company has to think about it. And another important aspect, we need to educate the promoters, the new promoters, is insider trading. SEBI is very, very strict about it, and they are monitoring very, very closely. And thanks to technology, now it is becoming very, very easy for them to monitor. So similarly, we need to advise the company to implement that structured digital database softwares in their company, and not to reveal any sensitive information with the brokers and with the public before making it before making any announcement in the stock market. So we need to educate this new promoter group that this is a very important thing, because SEBI is very strict and the penalties are very, very high. And not only promoters, we need to educate the board members, employees, and other stakeholders, including promoter means it's not only promoters, whoever are related, even spouse, children, brothers, sisters, relative as defined by the in our act. So they also come under this insider trading. Okay, so you need to educate the promoters about this insider trading. Now we'll take some case studies. This is one of the companies where I got involved. One of the first companies which had opted for this reverse merger. Okay, so the company equity is 1 crore shares of 10 each. That means maximum 10 crores. And promoters holding at the time was 75%. Public holding was 25%. But 9% shares were forfeited. So this company was taken over. 25% was placed beforehand. 4 crores was inducted into the company. Whatever the promoters had taken as a loan from the company through his sister concerns. So that 4 crores was pumped back into the company before takeover. And the 5 crores worth of software business and multimedia business was brought under the company. So 4 plus 5, 9 crores. So with the 9 crore capital and 9 crore business was brought in. So they were doing the business. And later, when in 6 months' time, the share price has gone to 170 rupees. And at 170, the shares were placed with the FI. That is one great success. And they got 15.4 crores back into the company. So earlier 9 crores plus 15.4. 24.4 crores have come into the company. Yet the new acquirers were holding more than 50% of the company. And the company was funded. So one way, the cost of acquisition was less than those days, 15x. And what the money they raised is more than 25 crores. And of course, with the existing business. So this is, this was one of the first companies that came for the public issue, reverse merger. And the model they followed and they adopted is very successful. Next one is grand success is Matrix Laboratories. The promoter he conceived this idea. He brought 3 privately held companies under a listed company. And they were in pharma business, they were doing pretty good. And the market has received them very, very well. And later it was sold to Mylan. And all the investors, acquirers, buyers of the company are happy. Because they were in business and they have done extremely very, very well. And later it was sold to American company. Another interesting thing is Patanjali. This happened through NCLT, reverse merger. So Ruchi Soya was taken over by Patanjali Group, and Ruchi Soya is a listed company. And Patanjali had almost 100% of the equity. And later they had to offload some equity. If you see, still they own 73.82% promoters group, and whereas public holds 26.18. So all the business of Patanjali was transferred to Ruchi Soya, and it is doing pretty good. there is last year it happened. It's a small company with 15 lakh shares of 10 rupees each. Promoter holding is almost 75%. It was taken by an Indonesian group. They are into commodities, gold, copper, palm oil, and coconut business. Now the share price has gone to 750 rupees. The promoter had spent something like 4 crores to acquire this company. And the present market cap of the promoter's holding is 84.37 crores. And the promoter has not sold a single share. And they are not planning to sell their shares also. But I should say that they are able to create a visibility, they are able to create a market. And if they can stabilize that market making, then this company can be up, can go to some levels. And this process got completed in 3 months' time. Next question is, why spending 4 crores and when there is an option to go for SME platform, BSc and NSC? Of course, this is also one aspect. As a consultant, you should see, is it worth spending 4 or 5 crores on the listed company and go for reverse merger? Or should we keep this money with ourselves and go to SME platform and get listed? But there are also expenditure. One advantage of SME compared to main platform is that you need not approach SEBI to get the approval. You need to submit your prospectus only to BSc or NSC. Once they approve it, you need to send one copy of your prospectus to SEBI for information. Everything is taken care of by BSc and NSC. And but you need to have a market maker. Again, as I told you, that you need to get this monies. You need to market your issue properly. So there are also costs involved in it. So it depends on your merchant banker and how fast you can get that money. You need to see pros and cons, as I mentioned to you. So should we go for reverse merger or should we go for SME or should we go for main platform? And, depends on your size and your requirement. Okay. If you see, there are totally 5,186 companies are there in BSc and 1,900 companies are there in NSC. This is the main platform. And SME, 251 companies and 349 companies, BSc and NSC. And still there is a great scope, and our country can, a population of 1.3 billion people with a very, very less. We have less than 10% of our population is actively involved in the stock market. So still we can, under 10,000 companies also can come onto this stock market and markets can take it up. Okay. So please encourage your clients to go for a listing, either reverse merger or SME or direct route. Markets can absorb. People are looking for good companies. Okay, so a few years back, in USA it happened. People go and go to the stock market, calling it as a special purpose acquisition corporation. And they'll say that we are going to take few companies in the healthcare sector or technology sectors. And as it is, they will not be doing any business on their own. Their main objective is to acquire companies. It is called SPAC. Okay, there is a difference between reverse merger and SPAC. Reverse merger, the company is already listed and it is a shell company. Whereas a SPAC is a new company and they go to stock market with the intention, okay, I will be acquiring companies in the healthcare sector and raise money. Okay, and they give within 2 years or 3 years, if you don't acquire, we'll return the money, things like that. So this is this happened in this model is available in the US market. I have not seen in this Indian market, but this is also one model. So what I'm suggesting, if you have instead of SPAC, you can say that I have a listed company. Under this listed company, you can bring the business also. If you have investors, and you can bring all people together and come up with a good business model in a specific sector. So you can fine tune this SPAC model, and this is the strategy what I'm proposing. So you can fine tune this SPAC in adapting to our country through this reverse merger route. Okay. Coming back to, you see why I put this photograph. This is a car where window is open, and if a bag is there, is it available for all the people, or whoever is going that side, can they pick up that bag? No, isn't it? Because if the window is open, that doesn't mean that people can take that. Similarly, when we are selling any shares, or when we are offering any shares to the public also, you should not do any misrepresentation, and you should not take advantage of people's weaknesses. So let us, as a consultants, let us not help any promoters to take advantage of stock market by unfair means. Okay, so that is one thing. We all need to see. This is not a right form to discuss about this right form issue and others. But if you go through, if you search the web, you can find a lot of information about that, how they are taken advantage of markets and people. Okay. So what I suggest, we have to be very, very careful. Even reverse merger or going for a public also, ensure that when the promoters are, it is the right company to go for public, and investors would be very happy. This is how I put it. We consultants need to educate the promoters and entrepreneurs that wealth creation means not getting enriched at the cost of small investors in the market. Wealth creation means the promoters need to ensure that all the stakeholders make or lose along with them. I mentioned losing also. Investors don't mind even if they lose. If the promoters also losing. But the promoters cannot be happy and enrich themselves at the cost of investors. So this is what I follow. And it's my humble request to all my fellow consultants, chartered accountants, to ensure that good promoters are coming into the stock market, so that we can create a good market, and investors also will be happy. So that's all. That's what if there are any questions, I'm willing to take it.
Thank you so much, sir, for your insightful session. I think people would have really liked it. So if you don't mind, I can take on the questions right now.
Yeah, please.
Just a moment, sir. So the first question is from Chandra Reddy. And sorry. The first question is, who will be ready to make investment if the shell company and the demerging company both are in financial distress?
Shell company and demerger.
Yes.
There is no question of demerger. I don't know what Mr. Reddy is thinking. So what I'm mentioning is there is a shell company and there is a privately held company which has business. If they don't have business, it will become minus into minus, again minus. So that is we should not advise or we should not even propose that. So there should be existing private limited company which should have business, which should get merged with the listed company. Then the listed company will become active in the stock market. I hope I made it very clear.
Thank you, sir. The next question is, how can a buyer ensure that ownership is not diluted?
Ownership is not?
Diluted.
No. Come again, Ms. Pooja.
How can a buyer ensure that ownership is not diluted?
What I understand what you are saying is if the existing listed company promoters are holding 75%, all the 75% can get transferred to these new buyers, new acquirers through share purchase agreement. So that way it gets transferred. So am I right? So that's what I'm saying. But if you are saying that the existing promoters of the listed company want to retain their holding, then the problem will come. Then it is an understanding between the existing promoter group and acquirers. Acquirers have to get into the company through preferential allotment, and they can take over the management. And if the preferential allotment is more than 25%, then the takeover rule is applicable. And then they have to make announcement. Then they can become promoters, and existing people can become public shareholders. That is also allowed through. I mean, that can be practiced or allowed. Yep.
Thank you, sir. Next question is from Shravya Gunukundi. She is asking, since the public float of a shell company will be very low, is there a possibility of manipulation in the script? What is your opinion on this?
Manipulations can happen whether it is a reverse merger or whether it is a public limited company. If the intentions of the party is different. So I do agree that most of the time the reverse merger, the public float will be very, very less. Sometimes I've seen in some cases less than 25%. So the buyer should always be the buyer of the shares. If the share price has gone up, very high and they're offering so for sale in the stock market, so we have to be very, very careful before buying such shares. So whether it is a shell company or existing company, also we need to analyze it, and then only we should get in. We should buy those shares. Yep.
Okay, thank you, sir. The next question will be from Ganesh, and he's asking, certain states have stamp duty on merger. In case of merger reversely, do we have to pay stamp duty? Does it not affect the total cost of funding?
Stamp duty means it's a share transfers only. Whatever stamp duty you have to pay for the share transfers, that you have to pay. But demat shares, my understanding is that there are no stamp duty. And since it is a public company, the existing promoters may be having shares in with some depository, CDSL and SDL, and it gets transferred to these people.
Okay, thank you, sir. The next question will be, who will be ready to make investment if the shell company and the demerging company both are in financial distress?
Nobody will invest. That's what I mentioned. Minus into minus results in minus only. So if how market price is determined? Market price is determined because of earning per share. Earning per share is a result of your net profit. Net profit divided by number of shares in the company gives you earning per share. earning per share into multiples of your PE multiples, price earning multiples. It determines the market price. So I suggest that marriage should not take place actually. Both should not be in financial distress. At least one should be doing good.
Yes, that would make sense. Yeah. I don't think there are any other questions. Are there any other questions? I request if you have any questions, you can ask. So we'll wait for 2 minutes and see if anyone has any other questions, and otherwise we'll be done with your part. Let's just
Right.
wait for.
And my email ID is there, phone number. That's my WhatsApp number also. If anybody wants any clarifications or any advice in future, I can be contacted. No charges. So, absolutely. Appreciate.
I don't think so. There are any other questions. Thank you so much, sir, for your valuable time, and we'll be very thankful. Thank you so much, sir.
Thank you very much, Mr.
Uh, Now, I would like to invite our eminent speaker, Rakesh Pujara sir, to have this virtual stage. Rakesh Pujara sir has over 25 years of trading and investment experience in the Indian equity markets. He completed his Bachelor's of Commerce from Mumbai University in 1992 and CWA from the ICWA in 1996. I am confident that his insights
Hello.
will not only be enlightening but also make this session a great and fruitful learning experience for all of us. Thank you. Over to you, sir.
Hello, everyone. Am I audible?
Yes, sir, you are.
I am audible, right. So, a little earlier finished today. 7:30 was the scheduled time, right?
Yeah.
Anyway, uh, Nandini already introduced me, and let me go to the presentation first, and I'll share my screen. Fine.
Yeah.
So today we are going to talk about rule-based investing in stock market. Uh, we have talked about a lot of things about trading in the market and creating wealth and all that. And we've already heard about a lot of fundamental based investing. Today, I'm going to talk about quantitative based, technical based, and completely rule driven algorithm based investing in stock market. And we are going to make it completely rule based, and I'll try and keep it as simple as possible so that even a layman can understand. And I'll be going with a little easy speed so that you can understand. And last 50 to 20 minutes, we will keep it for ask me anything kind of session where you can actually ask me anything, right? So my screen is visible, Pooja?
Yes, sir. It's visible.
So thanks. Thanks for your kind introduction, Pooja, first of all.
That's my pleasure, sir. Your work has been wonderful. So I think that those words were really small that I could express in this time.
I hope the participants take a benefit of whatever we have so far worked as a research, and our lot of investors have got benefited. I sincerely hope uh, the participants who are here take few lessons and do some homework and make money out of it, and I'll be more than happy. So we are a 6-year-old company called Compounding Wealth Advisors, and I've got 25 plus years of experience, as already told by you, and we pretty much cover all the aspects of the market, like equity investments, futures trading, options trading, and pretty much we are present in even technology space. We've just launched our Algotech platform called CWA Algotech, and we hope to uh, better the experience of retailers and investors in the market in this wealth creating journey. So I will skip this introduction since you have already introduced me. And so in, in investment, today we are going to talk about investment. I'll talk only about investment and not about trading. In investment, the single greatest edge an investor can have is a long-term orientation. Why we need to have a long-term orientation? In the next few slides, we will definitely uh, uh, cover that topic. And this is said by none other than Seth Klarman, who is considered to be father of value investing. And how, but how much, how many years will you consider as a long-term investment? So in the long run, everybody is dead. You know, in the words of John Maynard Keynes, in the long run, everybody is dead. So what is the long term for an investment? Like nowadays, with younger generation, they think even carrying an overnight position is a long term investment. They want to just do it intraday and finish it off. So let us understand some of the statistics that goes into long term investing. Equity investment is a wonderful instrument to create long term wealth, but you need to be really, really patient with the amount of time that you need to give to fructify the results. So, since we are a data-driven company, we are completely have a data-driven approach. We will speak only with data and nothing else. Let us see some of the key indices. Dow Industrial Average between 1929 and 1954, say around 25 years, Dow Jones Industrial Average delivered virtually zero return. So you are looking at a market where 25 years without index return, forget about stocks, even index did not deliver anything for 25 years, while GDP actually grew from 1.1 trillion to 2.668 trillion. So 141% growth in 25 years in GDP, but it never got translated into stock market gains. So there's a possibility, like 1929, many of you must have heard that it was an era of a Great Depression, and actually Dow Jones kind of fall by 90% from top during 1929. Again, it recovered and all that. But somebody who entered at the top of 1929 actually had to wait to 1954 just to recover its cost of investment. Forget about inflation and all that. So that is another cost. So this period again got repeated in 1966, 1982. Another 16 years of no return. See, GDP grew there about 4.4 trillion to 6.8 trillion. Again, a growth of 53% in 16 years, but market did nothing. So there is a possibility where such you can actually encounter such patches in equity investment. So you need to be really, really patient and long term in your approach. Somebody might argue that this might be specific to US market where a lot of exuberance happens, and then a lot of exaggeration happen on the downside as well. So a lot of volatility, a lot of participation there. But we analyzed other market also. For example, Nikkei index 1989 till date. Now it is now about to cross those 34-year highs. So 34 years, and market did nothing. 1989 till date, that index is not crossed its 1989 high. Somebody who started, for example, its SIP in 1929 would have broken even on their investment in 23 years. That was the kind of phase that some investor has faced in Japan. Again, economy grew in these last 34 years, it grew by 38%. So we are saying that there is no exact one-on-one correlation with the economy growing and equity markets rising. Of course, we are fortunate to live in a country like India where there is direct correlation, where earnings, where GDP growth is actually getting converted into earnings, and that is actually getting converted into equity indices scaling new highs and investor getting a plethora of returns. So Shanghai again, for example, Shanghai 2007 highs are still not crossed. Everybody talk of China and growing economy and number two economy in the world and all that. 17 trillion economy as on 2023. It rose from 3.55 trillion in 2007 to 2023, it rose to 17.7 trillion. Around 398% jump in growth in last 16 years in economy. But look at the index. Look at the Shanghai. Shanghai was 2000 high was 6,124, and the current indices are around 3,000 level. So it's a multi-year low, like almost 15, 16 years of no return again. Let us see how much market goes down during those periods. Between 1885 and 2010, Dow Jones Industrial Average regularly went down from top around 40-45%. You can see the spikes. These are like, we call it, in our terms, we call it drawdown. So when something rises from 100 to 150 and comes back to 100, we say it's a 33% drawdown from 150, for example. Or something goes down from 100 to say 80, then it's a 20% drawdown. So whether you draw down from capital or you draw down from profit, drawdown is a drawdown. So basically your portfolio fluctuates, and that fluctuation is measured in terms of drawdown. So you can see so many spikes since 1885. You see so many spikes. Market regularly fluctuates and goes down by 40-45%. In fact, in 1929, it went down 90%. Then it again recovered all losses. But in 2020 also, COVID, this very recent experience of all of us, market went down by around 55 to 60%. So you have to stomach this kind of fall if you want to be really, really long-term investor. There are benefits of long-term investing, but there are pitfalls also, like you have to stomach this kind of percentage falls. At the same time, you have to actually wait for so many years to get a real return sometimes. So we analyze Indian market also. Indian markets, what did it do? From 2000, we analyzed Indian market. Barely positive growth for 11 years. From 2001 to 2012, there was virtually no growth. Then the market started rising. Then it rose 5x in 4.5 years. From 2003 to 2007, it rose around 4.5 or 5 times in 4.5 years. That was a bull run that many of you might remember. 2007 was a very, very great bull market. And then the crash came in 2008, that the great financial crisis, and again market went down huge, and there was nothing. Like from this top for 5.5 years, market did nothing. So anybody who is stuck in 2007 highs got a zero return for 5.5 years. And again, after some time in 2013-14, market again started rising in 2017. After 2017, of course, the slide is not showing that data, but after 2017 also, market did nothing virtually for 2018, 19, and middle of 2020. And from the bottom of 2020, again, markets are almost 2.5 to 3 times. So returns always come in patches like this. And there will be patches like this where market does not deliver any return. So when you actually start investing, you don't know which patch you are actually hitting, whether you're hitting this patch, or whether you are hitting this patch, or maybe you are hitting this patch. So we'll show in a very, very data-driven manner how you can optimize these dilemmas and how you can go completely rule based to avoid any kind of such patch. This is the annualized return of last 20 years for different asset classes. So when you see asset class like equity is an asset class, US equity is another asset class, gold is another asset class, real estate is an asset class, and debt is again another asset class. So whether you do FD or bonds, or in that case you are just doing debt. If you invest in real estate, again you are doing real estate investment, and if you're buying gold as an investment, it is again an asset class. So last 20 years, this is the return profile. So equity investment is a clear winner. So 17.2% average is by far like more than two times of a debt, almost double of real estate, one and a half times of gold, and it is outperforming even US equity. So somebody might say, okay, India is a developing economy, and yeah, of course, markets are rising, and this could be a short-term phenomena, and market may not deliver later on, and all that. There are risks involved associated with equities and all that. All these arguments are valid. So we went like we do not have much data on Indian market, but US market we have a lot of data. So uh, we analyze those data as well. So this is total real return index of different asset class for more than 200 years. This is 217 years of data. It's huge, right, in terms of number of data. And in US, they maintain this kind of data. India, we do not have this. We have just started keeping updated data. So in US markets, just people, this kind of data are kept, and that helps us analyze. So what is this slide showing? This chart shows the long-term cumulative growth of $1 from the major asset class, as well as the average annual return that cumulative to those long-term wealth gains. So annualized real return. What is a real return? Real return is a return minus inflation. Suppose you got a return of 10% and there is an inflation of 6%. So what is the real return? Real return is 10 minus 6, that is 4%. So for 217 years, stocks has outperformed bonds and bills and gold and US dollar also. Gold real return is 0.6%. That means over and above inflation, 0.6% has been delivered by gold. So it's a wonderful instrument to protect your purchasing power. And fiat currency has delivered negative return. So it's worst thing to hold cash, and better than worse is probably gold, and better than gold is probably bills, and better than bills is basically bonds, and better than bonds is like stock markets are by far in last 217 years has delivered stunning return of 6.8% over and above inflation. So suppose you count inflation as say around 5-6% on an average for say 217 years, then you're looking at 11-12% of gain. But again, as I showed you in earlier slides, those returns are not equally distributed. Like when you say 12% per annum, it does not mean that you get a return of 1% per month every month. So it might mean that you get nothing for 3 years and you get 60% in the fourth year, and minus 30% in say fifth year, and again rise of 40%. This is the volatility that many people are not able to probably stomach, and that is the reason why stock markets are perceived to be very risky, and many people do not know the kind of how to go about it, how to invest, and that is why probably they pay the price of ignorance by investing in asset class that does not deliver the kind of return that are expected to deliver, right? So we have seen the benefit, like equity investment has definitely a benefit. Because of the past data, we can conclude that it has a benefit. It delivers better return than other asset class. And equity investing is a major part of our financial market. It is a time-tested method of generating massive wealth. SIP and lump sum investing in mutual fund, ETFs, and direct in stocks are the most common types of equity investing. These are in India, like we have mutual funds, you have exchange traded funds, and we have direct stocks where you can invest. We'll see the cost benefit analysis of all the methods of direct equity investing. So retail equity investors are generally they go through mutual funds and maybe exchange traded funds, and some of them, of course, are daredevils and they go through investing indirectly, either by themselves or they participate through uh, say PMSs or investment advisory, or in many forms they participate. So let us see some data again. So since 2013, Nifty buy and hold approach, like you buy Nifty in 2013 beginning and you hold it for say 10 years till 2011 years, 2023. What are the returns? So returns are scattered like this. 2013, 6%, this is 31%, this is -4%, this is +3%. So suppose you start here and then you have -4 and then +3. So you're like in 2 years you get tired, yeah, like you really don't deliver return. And the moment you get tired, probably 28% is delivered. The moment you get excited, about 28%, again 3% is delivered. So this journey is very topsy-turvy. But on an average, returns are around 12 to 13%, which replicates the ROE of listed space, return on equity investments, which is between 12 to 15%. So over a long period of time, indices will replicate return on equity investments, and which are between 12 to 15. So one single most important parameter, if somebody wants to track, is return on equity. If some company is earning, say, 30% on return on equity, then probably over a longer period of time, it is bound to deliver 30% return. So this is a Nifty buy and approach. But while you earn 13% return, this is the kind of drawdown that they go through. Every year, market falls from top, say this year 15%, this year 8%, this year 17%, this year 13%. So we take a maximum of this, like in 2020, market fell down by 39%. Okay. So maximum of this is 39%. And I'll keep this in mind. This is drawdown and this is maximum drawdown. This is average annual return. We'll use these two parameters to calculate Kalmar in the slides to come, and we'll understand how to use it. So a Kalmar ratio is nothing but average annual return divided by maximum drawdown. That is a Kalmar ratio. We will use it in the some few coming slides. Let us see investing in mutual funds. Suppose you are a good mutual, you have got a good mutual fund advisor, or you yourself are a good mutual fund picker, probably. Then you could have a better return than indexes. If you're a good, but fact of the matter is 70-80% of the mutual fund, even they do not outperform indexes. That is a fact. But suppose you figure out a way of finding a regularly good mutual fund, then what could be your return? Then your return could be in the vicinity of 19%. We have picked up best 7-8 performing fund of last 10-11 years. We have seen what kind of return they have delivered, and we have averaged those returns. And again, we have calculated what kind of drawdown they go through. Again, in 2020, they have gone through a drawdown of around almost 34%. And again, 19% return and 30% drawdown. Ratio is Kalmar below 1. Let us see if somebody is a good stock picker, what kind of return they could have achieved in last 10-11 years. So we have again picked up all the multi-bagger winners, the consistent compounders of last 10-11 years. Bajaj Finance, Bharti Airtel. Suppose somebody is a good investment advisor, a good stock picker, probably they could have advised you to buy these stocks. Then your return could have been in the vicinity of 27%. Again, the drawdown is 45%. So whether you buy indices or you buy mutual fund or you buy directly stock, one thing is constant, that is drawdown. If the market falls, everything falls. Return varies. Return varies between, say, in earlier slide, like for example, mutual fund. This is Nifty buy and hold had 13% return. Mutual fund, best of the best, had 19% return. But if you're a great stock picker, you can have met 27%. So this method probably attracts a lot of people, direct equity investing, because it has a higher share of return, right? And similar share of drawdown. Like all three methods go through the similar drawdown, and returns are better here. Naturally, people are inclined to choose this method. So we have calculated Kalmar of each method. So what is the Kalmar? Average annual return divided by 39. That is the formula for Kalmar. It has got a Kalmar of 0.30. So higher the Kalmar, the better. 0.5 is better than 0.33. 0.6 is better than 0.5. So higher the Kalmar, the better. You can Google it. Maybe you can study later when the session ends. And it's a very, very wonderful kind of a quick fix evolution of the method you are following. So this is portfolio buy and hold, Kalmar, and then this is again 26% return. This is stock picking kind of 27% return and 45% drawdown. The Kalmar of 0.59. Third method we had evaluated was mutual fund, which had got a return of 19% and a drawdown of 34%. So 0.33 say 0.56 is better, 0.56 say 0.59 is better. So if you have to choose only one, probably by now you will choose this. I'll come with the challenges of this also later. And the fourth method that we are talking today is system-based investing. This is a back-tested data of our systematic-based investment models that we have launched in Smallcase platform. cw.smallcase.com is our website where you can actually check our portfolio returns. And it is showing an average annual return of 37. One of our model, which is backtested, is showing average annual return of 37%. And it has got a drawdown of 24% and the Kalmar of 1%. So if you follow some rules and make it more systematic, you are likely to achieve 1 point. And we will demonstrate also how can you be rule-based. We'll demonstrate, we'll give you one system, simple system of investing at the end of this presentation, which will help you understand what kind of rules can be framed around system of investments, and you can do it yourself. You don't even need professionals sometimes. Since you are already professionally qualified chartered accountant, probably you can do it yourself. But if you can't do it yourself, probably you can always avail the professional services. There is nothing wrong with that, and because you might be engaged in your day-to-day life. So everybody agrees by now. Any confusion so far, Pooja? People are with me on this, or I'm not able to see them. So I don't know whether a small, quick yes, no, whether you are with me on this, or should I go
Yes,
slow or faster, or something like that?
definitely, sir. We are with you, and it is a quite insightful session we are having. And you can continue with what you are talking about.
Thank you. So in between, in case somebody has some serious doubt, probably they can bounce off. I've tried to keep it as simple as possible. So by
Yeah.
far we understood that equity investment, direct investment is beneficial. And if it make it little rule based, that is all the more cherry on the top. So we are going to make rule based in the times to come. But let us understand what are the challenges we faced in direct equity investment. Many of you must be investors, or maybe one time, or maybe you must be investors since long, or but everybody faces this challenge. The kind of challenges that I have enlisted here, it requires extensive research and analysis. Okay, because it is not like Bombay Stock Exchange has got more than 5 to 6,000 companies listed. Okay, so which company you will buy? So you need extensive research and analysis. Okay, it requires great deal of time, energy, manpower, and resources of various factors. For example, you need to track what are the global macros, like what is interest rate cycle, where is inflation, what is Fed balance sheet doing, where is crude price, and where is copper and all that. These are global macros that you need to track as if you want to do direct investing. What are the industry headwinds and tailwinds, which are sunrise industries, which are sunset industries? What are the headwinds and tailwinds, and which sectors are doing well, whether there is cyclicality involved or there is no cyclicality involved? What are the business fundamentals of each company? So once you finalize, like macro environment is good, probably which industry you should go, which sector you should go, which company you should invest, estimating the longevity, what is the kind of business model the company has, whether this company will survive for long or not, whether they have got moat and float and everything. Uh, then you come to complex financial analysis, valuation exercise, various ratios you calculate. Whether again valuation is again very subjective. There is no final formula which one can use. There are multiple ways of valuing a company and financial analysis. Still, you end up probably in a fraud company because of the management quality. Recent example being Polycab, for example. It's not. I'm not saying it's a fraud company, but there was an income tax rate and 1,000 crore worth of unaccounted income, and the company's market cap is around 73,000 crore. So such a large company, and still you will have corporate governance issue. and many of the best fund manager could not act and could not fathom whether management can indulge into this kind of unaccounted sales of 1,000 crore in such a big company. So management quality is again one more concern, and fortunately we have likes of Tatas and Birlas and other good quality management, uh, Murugappas maybe and several others. Fortunately, we have many such groups which are good quality management companies that gives us a lot of flexibility of investment. Again, after investing, it's not that you invest and you forget. Okay, so you have to continuously monitor. Like many companies, for like like few years back, Quality Dairy was the darling of the stock market, but then it went to zero. It got delisted, it went bankrupt, and earlier, like many Anil Ambani companies like Reliance Capital and many company, Reliance Housing and all that, they were darling of the investors in 2007, and then they went nowhere and they went bankrupt. Okay, and many companies like Jet Airways and Divan Housing and all these companies actually went to zero. So it's not that you just buy and forget. Yeah? You have to continuously monitor and track what is the news, views, information, and opinions. So you're seeing that there are a lot of challenges, right? Um, Again, even if you do everything like we have psychological issues, we have predetermined notions and biases with respect to particular stock or industry. With sometimes we fall in love with some stocks, sometimes we hate some. Like for example, in Adani stocks, there was a huge rally, okay, and it was the most hated rally in Adani stock. Like there were a lot of negatives around the group and a lot of negativity when stocks were rising. Okay, so you are sometimes we get fixated with negativity, sometimes we get fixated with positivity. Like we kind of turn a blind eye sometimes because we think the company is good, promoter is good, business is good, and that so a lot of predetermined biases and all this rules our mind. So and see, after doing also there's a lot of astronomical amount of subjectivity and discussion involved. Like what is the discussion you will use subjectivity, like which industry I will buy. There are hundreds of industries, hundreds of sectors. There are more than 6,000 companies. Okay, which company I'll invest, which particular stock I will buy, when I will buy. Today, tomorrow, I should have bought yesterday, maybe 10 years back. I'll wait for the correction. I don't know when to buy. Okay, and when I buy, I don't know how much to buy. I've got say, 1 rupee. Should I buy 5 paisa, 10 paisa, 20 paisa out of it? Maybe I should go all out and buy 1 rupee, all 1 rupee in one stock, or how will I write the winners? Fortunately, if it turns out to be a favorable stock for me, how long I will ride it? Like you buy it something at 100, it goes to 150, you sell, and that stock goes to 1,000 rupees, and then you repent. So you don't know how long you will hold it, and suppose you buy something and it goes down. I don't know how long you will hold it. Many IPO investors of Reliance Power in 2007 actually are still holding after 15 years. And after 15 years, the stock is still ruling at around 30, 32 rupees. So you don't know when to cut your losses, right? So, and it's very difficult to test and validate the investment hypothesis. Okay, whatever hypothesis you come up with, it is very difficult to test it in the go back in past and back test it, right? And in between, a lot of emotional turmoil, analysis paralysis हो जाता है. Sometimes we overanalyze and we end up doing nothing. And in the since the last few years, there is a lot of advent of social media platform which results into information overdose, impatience, and all that. So these are real challenges, and the most important challenge is timing the market. Okay, so market timing is very difficult. Investors who allow their emotions to get the best of them may suffer lower returns. So let us see again data. Since we are a data-driven company, we went into data. Average investor got 7.13% return, whereas the S&P 500 index got a return of 10.65. So this slippage of return between 1992 and 2021, okay, it is because people were trying to time the market. They were waiting for the bottom to happen. They were waiting for the top to happen, and they tried to time, and they could not time. And there is a slippage of the return, right? Again, we'll see some of the perils of trying to time the market. So, for example, if 7.82 return is delivered by S&P 500 for 30 years, okay? If you miss, so 30 years, for example, it has got how many, say 365 days. So, Motamoti, for example, it has got 10,000 days, right? 10,000 days. And say if you remove around, say, 35%, so around six and a half thousand trading days, it must be having, right? If you just miss 10 best days, your return goes down from 7.82 to 5.06. If you miss 20 best days, your return is only 3.3. If you miss 30 days, your return is 1.6. And if you miss 40 days, then probably your return is flat. And if you actually miss 50 best days, out of the 6.5 to 7,000 days, if you're not in the market for this 50 best days, your return is actually negative. So let us understand, if you might say we will avoid bad days, and probably we will end up with more returns. But another data suggests that bad days and good days happen in clusters. For example, 2008 market fall. This were the bad days and this is the good days. They happen in clusters. Okay, so there is no way you can avoid this without avoiding this. So if you miss this, you will miss this also. Okay, if you miss this, you will miss this also. So it's very, very difficult to time the market. And this is a very famous personality called Michael Burry, who the one who is famous because of his Big Shot. There's a movie called Big Shot. If you want to learn about him, you can see this movie is about the great financial crisis. Michael Burry has made, these are the two tweets that I would like to read out for him. After 2000, Nasdaq had 16 bear market rallies, okay? 16 bear market rallies after 2000, year 2000. Bear market rallies is rallies where actually market is in a bear condition, but market rallies, okay? And the rallies were greater than 10%, averaging 22%. So if market rises by 22%, people start believing it's a bull market. But no, it all gave up its gain again. So before bottoming out at 78%, okay? The market actually fall from top to 78%, and in between it had got 16 bear market rallies, averaging 22%. Okay. After 1929, the Dow had 10 bear market rallies, greater than 10%, averaging 22%, before bottoming out at 89%. Okay. So in between, market will rally and it will look like a bull market, but it is not a bull market, it's a bear market sometimes, and you don't know, there is no way of figuring that out. Again, the second tweet said dead cat bounces are the most epic. 12 of the 20 Nasdaq one-day rallies happened during this 78% drop. So when actually market dropped 78% from top, in between 12, 12 rallies out of top 20 rallies were in this drop. Okay. In 2000, top 9 of top 20 S&P 500 one-day rally happened during 86% drop. So the point we are trying to make is very, very difficult to guess the environment. Trying timing market is a futile exercise, and missing the best and worst days sometimes, affect your returns, right? But if you figure out a way of missing the best and worst days both, okay, and reduce exposure during market volatility, then probably there is a chance that your return can actually improve. So this is an area of research. Then probably we are figuring out a way of staying out of best and worst days both when they happen in clusters, and probably try and improve the return for our investors. Okay, and we have tried to make it a little more rule based. Okay, all this research is by Wells Fargo, so we have given credit to that, and you can actually read. It's a wonderful report by Wells Fargo, and so far we understood that equity holds promise in terms of delivering better return than asset class. it has got its fair share of volatility that exists, and because of the volatility, not many people are able to invest regularly and stomach the kind of volatility. Then we see if you try and time the market, then again it is very counterproductive. Okay, and if you try and analyze market fundamentally, also there are a lot of challenges. Like you need to have those analytical skills first. Even if you have the skills, so many sectors, so many industries, so many discussions. So these are the challenges. Okay, so we have solved these challenges, and we have ventured into systematic investments. So systematic investing, basically, it's a rule-driven approach, data-driven approach. Systematic investing removes subjectivity and discretion with regard to universe of stock, which stock to buy, timing of entry and exit, position sizing, risk management, and money management. Everything is defined and it's rule-based. And I will illustrate you one example also, and we are going to give away that system absolutely free to all of you, so that you can start trying your hands of investing by yourself in a complete rule-based manner. So it automatically results into diversification such that any particular stock does not make or break P&L. So we allocate a certain percentage to certain stock when we invest. So even if that stock goes to zero, basically your portfolio, it is not more than the percentage you initially initiated. So there are allocation rules. This leads to sector agnostic portfolio, free from biases. So basically we are following all price action based strategies. When the price moves, our algorithm gets activated and we invest into moving stocks, and that automatically results into sector agnostic. Like we do not track sector specific ideas. We just track the company, and we track just the price. So once the price moves, we get into the stock, and once price starts falling, we get out of the stocks. It's as simple as that. Okay. So this results into, like, we are not whether we are in pharma or FMCG or maybe metal, we don't know. Whichever moves, we are there. So uh, this this process is just a clarity of thought. Okay, absolutely, you can be clear about what you're doing. And at Compounding Wealth Advisors, like CW is just acronym for my company called Compounding Wealth Advisors. How did we solve these challenges? Okay, so far we talked about merits of investing, direct investing, and all that. There were a lot of challenges. Now we'll talk about how to solve this. Okay, ultimately. So TW had developed process-driven approach towards stock investing. Okay, we have developed several systematic investing strategies involving extensive use of qualitative parameters, technical analysis, and price action concepts. These systems are designed to let winners ride and cut losers short. So I'll spend some time here. What do you mean by let winners ride and cut our losers short? So when you buy something, suppose at 100 rupees and the stock goes to 150, there is an urge to book the profit. Okay, and it's very absolutely human to have this kind of urge. Even I have it. Even many successful investor has it. But what happens is such stocks which you buy and it rises, and because of the urge to book the profit, you sell, they rise further. Okay, they go to 200, they go to 300, they go to 500, sometimes 1,000, sometimes 2,000, and all that, and you miss out on the entire rally. Now the other part. Suppose you buy at 100 rupees and it falls to 80 rupees, and you do not cut your loss, then probably sometimes it goes to zero also. So recipe for creating wealth is you have to let your winners ride. Okay, let your 100 go to 150 to 200 and 300 and 500, and cut your losses. Okay, if something goes from 100 to 80, there's something wrong with the company. Please get out of it. If you observe portfolio of very successful investors like Rakesh Jhunjhunwala ji, you will find that there are few companies, two, three, four companies which occupies 90% of the value of the portfolio. Why? Because they have let the winners ride. Titan, for example, he bought around 85, 90, 100 rupees. He's still holding in his portfolio. So that is why it occupies a very large space, percentage of the portfolio. For example, Crisil, Lupin, and all that, Escorts, and all, he's holding since so many years, so maybe decades, and he's still riding them. So that is the recipe for creating wealth. We have leveraged a lot of technology, and we have tested and validated these strategies on thousands of stock over a period of last 12 years. We have done robustness check, have been performed with these rule-based investing systems. And these are the 6 strategies that we have listed here on small case, and these are the backtested results. Okay, you see they are far better than other modes of investing. Kalmar is almost above 1 in all cases. Investing, if the Kalmar is more than 1, then it's fantastic, and that is how it is. It's more than 1 in almost all the cases. You can visit here and check out the perform. And this is the combination of all these 6 investment strategies that we use. As an example, this is the equity curve. You see, nothing happens for a few years, right? 2018 to 2020, then suddenly there is a rise. Then 2021, 22, nothing happens. Now in 2023, suddenly there is a rise. So this is the typical rise of equity investments, and our backtested results showed it can achieve a CAGR of around 30, average annual return of 32, and maximum drawdown of 22, 1.5 Kalmar. Exposure in the market is 68. So why you think we are able to achieve something like this? A better CAGR than indices, better CAGR than mutual funds, better CAGR, because we are exposed to the market only 68% of the time. What do we do? Well, 32% of the time, we remain in liquid. So when the market actually goes down and there is a bear market, we remain liquid. And there are rules which tells us to go liquid, and we go liquid. And it has got a sharp of 1.5%, which is supposed to be very decent in investing world. Okay. And this is the kind of drawdown that our portfolio would have gone through in past if it was live stream. Our portfolios are live since only March 23. So all this result what I'm showing is it's academic exercise, and it's not a recommendation to buy and sell. It's not a promotion also. It is just for academic exercise. Okay. And future might look different, and you can test your own hypothesis. So far, so good. Everything with me, Pooja, because I'm going to give away some framework absolutely to be used by all of you from tomorrow. You can use the entire framework with rules, and we are going to give away those systems. So if you've understood things so far, probably we'll go ahead with rules and the systems and how they can use it to make money.
Definitely, sir, we are with you. And from the audience, I would request if any one of you have any questions till now, you may ask. I think, sir, everything is good and there are no questions till yet, and we are ready to move forward.
So there are 2 scenarios where you have no questions. Either you understood everything or you have not understood anything. I hope you have understood everything, and I'm going ahead.
I believe so, sir.
Anyway, so our investment strategies are purely based on technicals. So I'm going to give away one such strategy as an illustration so that you have a glimpse of like kind of things that can be done for investing, right? Hello. So universe of stocks is NSE listed liquid scripts, around 1,500 of them. Position size is 2% of capital. We call this system as CWA2 sigma. I'll give you the reason why we call it CWA2 sigma. Why we call it, I'll come to that later. What is the universe of stock? NSE listed liquid script, around 1,500 liquid scripts we have selected for this system. Position size is 2% of capital. So when we buy any stock, we do not allocate more than 2% of capital to that stock. So by this logic, you can have 50 stocks into your portfolio. What are the entry rules? I don't know how many of you know technical analysis, but anybody who knows technical analysis will know what is a Bollinger Band. So entry rules is like a weekly close above upper Bollinger Band, and the setting of Bollinger Band is 50-2. Okay, so that is a setting. Weekly Bollinger Band is a very famous indicator in the technical analysis world. If you sketch the surface of this field of technical analysis, you will know what is a Bollinger Band is. And if you don't know, I think it's worth knowing. You start Googling it probably, and you start understanding what is a Bollinger Band. And I'll show you how does it look, and how does it feel, and how you can use it to make money. Okay. This is the entry rule. So far, so good. Entry rule is weekly close above upper Bollinger Band. Bollinger Band has three factors. One is moving average, which is at the center, and there is an upper band above moving average, and there is a lower band. This lower upper band is located at two standard deviation from the moving average, and lower band again is located at two standard below moving average. Since it is an investment strategies, we just use the upper band, okay, upper Bollinger Band. We don't use the lower Bollinger Band. So anything that moves beyond two standard deviation of 50 moving average, that is where you trigger a buy signal, okay? That is why we call it 2 sigma. 2 sigma is nothing but two standard deviation. So when the price moves above 50 moving average and then it moves beyond two standard deviation, that is when you buy, okay? And how much you buy around 2% of capital, okay? So when you buy 2% of capital, suppose you have got 1 lakh capital, you buy 2,000 worth of stock. After buying, what do? You hold till when? Either your initial stop loss is clicked, which is 20%. So when you buy some stock at say 100 rupees, your initial stop loss at 20% means that if the price falls, weekly close price falls below 80 rupees, you should do the stop loss. Okay. So you should get out of the stock. Or this is not and, this is or. Either this happens or close below 100-week exponential moving average. Again, this is a very simple indicator, exponential moving average. You can find it on TradingView. I use TradingView, so probably we have developed this indicator on TradingView. Again, this is not a promotional exercise for promoting TradingView. Since I use it, I'm showing it, right? So there's an indicator called exponential moving average or a close below average true range. There is something called average true range. What is the range? Range is basically difference between high and low is called the range. Average true range is the 14 days average of true range. And if you multiply it by 1.8 times, the average true ATR of 14-1.8 comes. So if either of these three happens, whichever is earlier, you exceed the stop. Okay. So everybody is clear about the rule, entry rule, weekly close above upper Bollinger Band. I'm going to share this slide, so don't worry about it. I'm going to email it to Institute so that you can use it for yourself. Anything you have not understood, you can again go through it. Probably I'm going to give away my contact detail as well. You can always email me. I'm available on Twitter and everywhere I'm available. You can always come back to me about the rules. So this is the rules and everything. And these are some of the examples. If you had followed this system in past, what kind of multi-bagger you would have probably picked. So this is CG power, okay? So using this, now let me, with illustration I'm showing you, this is the candlestick chart, weekly stand candlestick of CG power. This blue line is the upper Bollinger Band, okay, which is two standard deviation away from 50 moving average. This dotted line is average true range, 14 days ATR multiplied by 1.8. And this red line is 100-week exponential moving average, okay? So let us see what happened here. So it triggered a buy condition on 23rd of October 2020 at a price of 25.90, okay? Initial stop loss was here around 20 rupees because of the 20%, but it never triggered the stop loss, okay? This yellow line is nothing but a buy line, and this dotted line is nothing but the initial stop loss line, which is around 20 rupees. So after buying this, price never went below 20 rupees, so stop loss was not triggered. We kept on holding till we triggered kind of so we are still holding, and the price is around 480, 456 rupees. So around 1488% rise. Okay, you are still holding since last 2.5 years. Maybe 3.5 years, not 2.5. 3.5 years, and still probably stop loss is 399 rupees and price is 450. Still it is 50 rupees away from stop loss. 100-week moving average at 307. So till such time the price does not go below this or this, we are not going to sell this stock. So imagine a stock bought at 25 rupees, price is 450 rupees. Still, your indicator, CW2 Sigma indicator, is asking you to hold if unless the price falls below 400 or maybe 307, whichever is earlier. So this is one example. One more example I'll show you. Avanti Feeds, it triggered a buy here on 13 September 2013 at a price of 15. Okay, Avanti Feed is a company, it produces some marine products, and see where the exit came. When the price went below this and this white line, the exit came at 515 rupees. Okay, so almost 5 years of holding, and price went above. From 15 rupees, it went to exit signal came at 515. 3,200% return in 5 years. So these are the kind of multi-baggers that you can pick with this kind of simple rule-based approach. Sometimes you might feel Avanti Feeds and all that CG Power turnaround story, but it might not be catching blue chips, but it has caught blue chips like Britannia in 2013 at a price of 283, and it sold it on 2018 at a price of 3,114 rupees. 1,000% rise in 5 years, 5.5 years. So these are the kind of multi-bagger it catches. Very, very simple rule. And this are again one more example. Indo count buy triggered at 3.7 rupees and sell triggered at 192 rupees, 5,000% increase. So these are the kind of multi-bagger that you can find. And this is the back test of last 13 years. Okay, 13 years. If you had followed this CWA2 Sigma indicator since 2011, what kind of return you could have generated for yourself? CAGR of 25% and average annual return of 13%. Very simple, very much doable. And what is the average trade per month? Only 4 trades and 2% allocation, that is 8% per month. But your portfolio will churn once in a year, kind of. What are the statistics? 39% winning trade. But you don't need to be right 100% of the time. Even if you're right 39% of the time, you make money. Okay, you're wrong with this indicator 60% of the time. Still, you end up making money. Why? Because of this payoff ratio. Payoff ratio is 9. Okay, when you win 134%. When you lose 14%. So this ratio is 9 times. When you lose for 15% and when you gain 135%. What is the average holding period? Average holding period is 769 days. Again, this is year-wise distribution of return. In 2023, this indicator alone would have generated 51%. Okay. Even in 2020, it generated good return, 21, 23. So this is a consecutive 4th year that generated positive return. These are the likely holdings of this indicator-based portfolio approach, rule-based approach. These are the likely holdings, the price at which the buy was triggered, what is the date at which the signal came, and what is the current price, and what is the percentage rise. Okay. So you are seeing some good winners like CG Power and HBL Power and all that. Some mild winners like this negative VIP closing and all. Since it's a bull market right now, you are not seeing many losers here, like something like Suprajit triggered in March, still not delivering any return, still hovering around the same line. So you will have some negative return, you will have some flat return, and you will have some stupendous return like this 2,000%. And mix of that is like this 15% return or a 12% return, because there are a lot of losses. 60% of the trade goes into losses. Okay, that is again a reality. 60% of the loss trades got into losses. Still, you lose less. Why? Because there is a fixed stop loss. Okay, so average losing trade has minus 15%, and the average gain is around 135%. And the maximum drawdown that has happened 39%, which is in line with other methods of investing. We trade like mutual funds and ETFs and all that. Drawdown again here is 39%, but the return is way better than others. And why we are able to do this? Because of this, I told you the earlier, like 68% of the time we are out of the market, right? That is the statistics we showed you. Slippage sensitivity, sometimes, at what price the buy is triggered, what way you end up buying, there's a difference. So we generally, while back testing, provide for 1% slippage. That is why the statistics of 25% and 31.2% and maximum drawdown. But suppose what if the slippage is more than 1%? Like Monday market opens and you are not able to get at the same price, there can be a slippage. Slippage can be positive also, negative also. Like if something triggered at 100, probably you get it at 99, there is a positive slippage. But if you get something at 101, there is a negative slippage. Okay. So, but even if your slippage increased from 1% to 2%, your returns are still like very decent, 22%. And that is the robustness check that we have done. Portfolio churning is 8% per month. It's very, very tax efficient. Why I say tax efficient? Because your losses are always less than a year. Okay, average holding period of losses is uh, less than 1 year. That is 300. An average winning period, we let the winners write 165 days. And and that is why the average holding period is 750 days. Winners are holding for 1365 days. Losers are holding only for 10 months. So by now, I'm sure you must be itching. How can I get this system? And how can I use it? So that is why we are giving it away for free to all of you to use. You just have to simply scan this, fill this form, send a request to us, and we will enable you with the access of TradingView. You should have a TradingView free version. Okay, you don't need to pay anything on TradingView. And once you scan this, send this to us, we will enable the access to you. So you go to the indicators, go to the invite mode, and then you will be enabled, and you will be able to check your portfolios, whether it is in buy, whether we should hold, what is the stop loss, what are the new stocks that come in when you scan the stock. All this you will be able to do it on your by yourself. If you have any confusion, anything, any problem, you can always reach out to us. I hope you have scanned by now. If you've not scanned, also we are going to actually send the PPT to the institute for you to be used, and you can scan from there. And these are my contact details. WhatsApp number. This is email. This is Rakesh Pujara. One is my Twitter ID. Rakesh Pujara 7289 is my YouTube, and my website address. So you can reach out to us anytime. And I hope you liked the presentation. And if you liked it, uh, probably you can share your feedback. Even if you don't like it, you can share that. And I'm open for questions, Pooja.
Thank you so much, sir. Now let's
Should I
take
stop
the
sharing my
questions.
should I stop sharing my screen now?
Yeah,
Or
definitely, sir. But
I
maybe
hope
you can
everybody
wait
has
and you
scanned.
can. Hmm.
I hope everybody has scanned or and noted out the contact details just in case of confusion. I'll stop sharing now. Yeah.
You
Okay.
can wait, and maybe some doubts might be cleared with the help of PPT.
Okay. Okay. I'll keep it that way. Then. Okay.
Yeah.
Yeah.
So the first question is from Kishore Kumar, and he's
Yeah.
asking, "What is Sharpe?" This there is a
Sharp.
slide
Sharp.
showing
That
Sharpe
show.
1.5
That
and Calmer 1.57.
okay. So Sharp ratio is a measure of evaluating whether what are the kind of stability the system is giving. Anything less than one is not a good sharp. Anything above one is a good sharp. So sharp basically, suppose average annual return is around say 15% example. How this 15% has arrived? That is important. So in year, suppose you lose 20%. The second year, suppose you gain 20% example. I'm just giving you a very basic example. And the third year, you make say 45%. The total of what is the total return is 45, right? And when you divide this by 3 years, it is the average return is 15. But the journey is very volatile. You went to minus 20 to plus 20 to 45. The more stable the journey, the higher the sharp. Okay. So there is a formula for sharp available. You can Google it, and it actually calculates the volatility of returns. Okay, how volatile the returns are, and higher the sharp, the better. And Calmer, as I told you earlier, Calmer is average annual return. So suppose you have 10% return in 1 year, 20% return in second year, and 30% return in third year. The total return is around 60%. And if you divide by 3 years, the average return is 20. So sharp is this 20 divided by maximum drawdown. So what is a drawdown? So everything, all prices do not rise 45-degree, right? They go up and down and everything, right? So uh, the journey they follow, in between they like something goes from 100 to 200 and then comes down to say 150. So this fall of 50 rupees is called drawdown. And in percentage term, for example, something goes down from 200 to 150, it is called 25%, right? So this is drawdown, maximum drawdown that happens during the year. That is called maximum drawdown. And whatever period backtest you are using, so you have to take maximum of all the period. So like in 2020, the market fall by 40%. So that was the maximum drawdown. But 2019 market fell only by 11% from top. That was a drawdown of 2019. But when you are actually evaluating a period from 2013 to 2023, you should take the maximum drawdown, which was in 2020, and that is 39 to 40%. And average annual return, for example, 20, then 20 divided by 40 is half, and that is what is the Kalmar is. In case of Kalmar, higher the better. And like our systems has a more than 1.5 Kalmar. Like an average investing strategy might have 0.5, 0.3, 0.3, 0.6, 0.7, and some of the strategy might have higher than one, but our strategies have higher than one Kalmar. Okay. I hope I've answered.
Thank you, sir. The next question will be entry rule weekly close. How many weekly close?
How many weekly close? So it's a 50-week moving average. That is what the moving average is. And Bollinger Band, that is two standard deviation away from 50-week moving average. And if price closes above that, then you have to buy. Okay. Though the
Tha-
standard setting of Bollinger Band is 20, but TradingView goes allows you to change the setting. So go to the setting, change the setting from 20 to 50, and two standard deviation is the upper band, and price closes above that during the week. Say Friday closing is above that. That is when the buy is triggered. You have to buy Monday morning first thing. That is how it should work.
Thank you, sir. The next question will be from Arun Sankar,
Yes.
and he's asking how to identify swing and multi-bagger stocks.
So
Rajesh,
multi-bagger stock.
exports multi-bagger.
Yeah. So multi-bagger stocks, I've given you the indicator for free. You can identify using, you can scan the stocks, and every Friday evening after close, you can scan the stock and see what buys are triggered. And see every stock that qualifies as a buy in this indicator will not result into multi-bagger. Okay. So key is not indicator. Key is the money management rule, allocation rule, and letting the winners ride. Out of 10 stocks, for example, six stocks will trigger your stop loss, right? But for stocks which does not trigger your stop loss might rise, and if you allow the rise to ride the winners, then some of that might convert into 1,000% return or 2,000%. So you can expect out of 10, one or two will go to multi-bagger, and that will change the profile of your return. Okay, that will make bulk of your return, and that is how you can use this indicator. Go to TradingView, just scan it here. uh, we will grant you the access by say Monday evening or Tuesday evening. Then probably you can start using. You can drop in your. I've given you email also. You can drop in your whatever queries you have, and it's a wonderful thing. And use it, and then probably you can come out with your further queries.
Thank you, sir. And there's one comment by Ankit Garg. He's saying it is a good presentation. Thank you, sir.
Okay, thanks, Ankit.
Uh, And the next question is, I think I will be answering that. And this is how we can access the session online. So you can go to the ICI site, and there will be ICI Live TV, and you will be able to see the recording of all the sessions ICI has been conducting till now on that portal. Uh, and I may request all the other applicants, if you have any other doubts, you may ask now. We'll be taking the doubts soon.
So what? So just to give you, just ask you something. How many attendance already? Like how many people are attending this session? Hello, am I audible?
Yes, sir, you are audible. Actually, as a part of webinar, we can't see how many people are attending this
Okay,
particular
okay.
webinar.
So
Yeah.
let's assume say there are 200 people. So out of 200 people, say how many will be kind of conversant with the language I'm using? Like 50%? I don't know. 30%, 10%, 20%? I don't know.
I believe, sir, everyone will be conversant with your language because you are using very normal
Okay.
English that we can use. Yeah. So I think
No,
that
no,
would
I'm not
be
talking about English. What I'm saying is the technical, like Bollinger Band and
technicalities. If I talk
CAD.
about, yeah, we do study these things during our
Okay.
study tenure. So I believe we will be understanding
Yes, yes,
these
sure.
terms that you are
I hope
using
you
in
have
this
understood,
particular.
Pooja. I don't know about others.
Yeah, definitely, sir.
Good.
Uh, I don't think there are any other questions. Thank you so much, sir, for your prestigious time. I'm really thankful.
Thank you.
So, ladies and gentlemen, as we conclude this insightful webinar conducted by Committee on Financial Markets and Investor Protection (ICAI), I extend my sincere gratitude to our esteemed speakers, participants, and the organizing team for their invaluable contributions. I'd
I
like
see Venkat sir. Namaste, sir. Sorry,
I'd
sorry
like
to interrupt.
gratitude to the Committee on Financial Markets and Investor Protection (ICI) for their continuous efforts in promoting knowledge and excellence in the field. Thanks to all the attendees for your active participation and engaging questions. A heartfelt thank you to our technical team and everyone behind the scenes who worked tirelessly to ensure the smooth execution of this webinar. Let's carry forward the knowledge gained today in our professional journeys. We look forward to welcoming you in the future ICI events. Thank you and have a wonderful day.